Hello there and welcome to the Outspoken Market. Leandro Guerra speaking. Today's class it's about reading options risk in a simple way. We are going to learn how to use delta, gamma, theta, and vega. There are other Greeks for the options, but they are not necessary. You can do 9% of everything that you need when trading or hedging your portfolio if you know by heart the content of this class from these four Greeks. Now, in previous class, we understood the mathematical intuition around them, or better saying, around the main ones for both put and call options. For today, I bring you a table that will be your quick reference to the main aspects of each one of them, is starting with the delta. And for example, what does it measures, right? What can be understood when you see the delta value of an option? Now, you can understand as the change in the option price as 1 unit of their underlying asset moves. So you have something, for example, that costs $100. What happens to the option price if that goes to $101 or it gets down to $99? This is the delta. So that value you're going to see from that option, it's the change expected for a 1 unit move in the underlying asset. So if your delta is 0.5, for example, if that underlying asset goes from 100 to 101, your option is going to move 50 cents. If by whatever the reason your option already has a price of $1, it will go to 150, meaning that you're gonna earn 50%. Yes, for speculative moves, it's amazing, but the opposite may happen as well. You can lose 50% if that is the case. What is the intuition? It's quite simple. It's how many synthetic shares the option carries. Why is that? Because one practical utilization of the delta is to hedge the portfolio or measure directional exposure. So you can convert your option position into stock equivalents. Or if you have a portfolio with stocks, you can do a simple calculation that is going to show how much you have to buy or how many options you have to buy or to sell in order to lock in the value of your portfolio against very dramatic moves up or down. That's why they can be understood as how many synthetic shares they carries. For example, for a call option, if you are long on it, for simplification, delta, for example, will vary from 0 to 1. If the underlying rises by 1, then the call will gain approximately the delta price, as we have seen. And the delta grows as the call moves in the money. It's precisely the opposite when we speak about a put option. So if you're long, if the underlying asset rises, your losses are going to be equivalent to the delta. They are very deep in options that are in the money. They will always have opposite signs because they will vary differently depending if you have a put or a call. You will have a different directional movement depending on which one you have. And the rule of thumb that it's very nice to remember, delta approximately is the probability of a particular option finishing in the money. When you have that at the money, the value will be around 0.5 because it can be anywhere above or below that particular number. So it's quite straightforward. The biggest takeaway is exactly this one, the intuition, of course, the measurement, and the practical utilization. The other components are nice to be understood, so you have the directional intuition about what is happening. The next one, it's the gamma. Now, delta, it's also called the first derivative. The gamma will be the second derivative. So it's the acceleration of the delta. While the delta represents the velocity of the change in the price, the delta, it's okay, how fast I am going, how fast the delta is changing. Gamma, it's always positive, either if you are speaking about a call option or a put option in this case. Therefore, gamma is the change in delta for a 1 unit move in the underlying asset. Delta was the change in the option price for that particular 1 unit in the underlying, and this is how much the delta would change. Gamma is maximum at the money. In the opposite way of the delta, that will be around 50 if they are at the money, and then the more they are in the money, they are the largest. Gamma gets its largest at the money because any sensible change from that area eventually will have your delta not accelerating that much because it's already in the money or it's going out of the money. Maybe it will lose its value. The typical sign, it's always positive and helps traders and investors to manage, they call it near-term convexity risk. Now, there is a calculation, and it's the calculation that we are doing every day and presenting in our newsletter, that it's the gamma exposure. It's amazing to understand where market makers, where the dealers are having to position themselves in the market to hedge or to cope with the expected movements of their functions. We will have a class, likely the next one, only about gamma exposure. But the intuition here is whenever you see a high concentration of gamma, it means that there you may have a supply zone, a demand zone, or an acceleration zone. And this can be understood by the signal of the gamma in the sense that it's always positive, but if we are understanding from the dealer side, the dealer will have to buy the options or to sell the options or to buy and sell the underlying asset in order to be able to protect their position that they were building while providing liquidity to the market or while hedging their directional exposure in this case, and you can have the reading of that particular movement through the gamma. The rule of thumb, a high gamma will trap the sellers and help the buyers. If you are close to the expiration, small moves are going to create a very large swing in the P&L. Because any change, it's extremely dramatic because they are maximum at the money. The other one is the theta. That is the change in the option price as the time passes by. It will be like the time decay or the rent you pay for the time that you are positioned in the option. It doesn't matter if it's a call or a put option. The typical sign of the theta is always negative because if you carry the option loses value with time, so you lose money with time. you must, if you are in a long position for the theta, you must have price movement. Now, then you can understand the opposite, it's true. So if you are in a short position, you're going to make money with the theta because you have sold options. So you got the value of the option as an input in your portfolio. The time passed by, the value of the option will decay, meaning that when you will buy back the option, you're going to buy it, assuming that there was no movement, by a lower price, only because of the delta. It can also be understood as the cost of carry. And if you have no move or no change in the implied volatility, you have the decay. And the closer you are to the expiration, it is going to hurt you more. That is what we have seen in previous class. That we had the mathematical approach. Here you have the intuition and how you should be doing the interpretation. Last but not less important, it's the Vega. It relates to the implied volatility. So how much the option price is going to change by a change of 1 point in the implied volatility. So it's the sensitivity to an expected movement. That is the main intuition. It's always positive because it could be much higher than 1 or between 0 or 1, and will be maximum at the money and larger on longer maturities because you have time to be exposed to the implied volatility. But Vega decays as well, not making only the option price lose value, but the value of the Vega itself decays as the expiration date approaches. Now, if we have event trades like Fed announcements, any other things, or you are thinking on managing, buying or selling volatility, expecting a crash or some stability, this is one of the things that you have to look. For example, long straddles, they will love if you have long implied volatility or an increase on it, because it means that you are buying volatility. And for the short straddle loves implied volatility down and hates up. So it's the opposite of the long straddle. I mean, for the whole point on these 4 Greeks that we have seen, this is what you should know. Any exchange, any broker that is serious, they will provide you information about the Greeks for each one of the strikes, for each one of the expirations date that are going to be available. Now you can quickly take a look on each one of these numbers and quickly understand what they mean and what you should be doing at the implied risk. Of course, this is a simplification. You have to do some calculations. As I said, if you are measuring the directional risk and want to hedge your position against the exposure of movement, this is for another class, but at least now you know what it means. And my personal view, something that I have been trading a lot, it's exactly the gamma exposure, because this is the tip, this is the biggest intuition we can have about how the market is moving together with machine learning models applying for trading, and you know where you can expect a movement to happen eventually the direction of the movement, depending on the signal that you have for that particular exposure in the gamma, and then position yourself accordingly. My friends, thanks for watching. Thank you very much for being here. Like, subscribe, share with your friends, and see you next time. Take care. Bye bye.